So my good friend and longtime acquaintance, Brad Sumrock, who has trained and taught almost every successful multifamily real estate investor that I know, which is only like 24, so it's not that many. That was a joke, right? Because that's like thousands and thousands of units under the age of 40, right? So the guys that are 60-something, Brad, that I know that Brad didn't get to teach yet. But you really got to listen to this guy, and you're actually in for a treat because Brad's not here to sell you a boot camp or sell you a training session. Brad is here to teach you, as we believe in here at DFW Investors, about being a multifamily investor. And right now, if you can glean on to a couple little morsels during this next 40 minutes, 45 minutes, whatever it is, I'm telling you, that's like the hottest market in Dallas-Fort Worth right now is multifamily. So without any more delay, Brad Sumrock.
So how many people in here already invest in apartments? Can I see a show of hands? How many people already invest in real estate? Single-family rentals? Any other asset classes? Anybody doing commercial that's not apartments? Okay, I just like to get to know the audience a little bit. So what I'm going to talk about is is it okay if I stand down here? I feel a little awkward standing up on the podium, and I'd probably slip and fall. So I don't want to hurt myself, so I'm just going to stay here. I'm going to talk about apartment investing, how I got started in apartment investing. So I'm going to give you a little bit of background about who I am and what I've done. And I'm going to talk to you about how I was able to retire from a six-figure income in just 3 years after investing in apartments. Is there anybody in here that already has a job right now? I mean, most of you probably have day jobs, right? So don't quit your day job yet. Wait until you replace your earned income with your investment income before you quit your day job. I am going to talk about why I love apartment investing, and everybody should have a flyer for you to take home that has some of the highlights of what I'm talking about. It should be on every chair. And so I'm going to talk about that. Why I love apartment investing could also be summarized as what are the key benefits of investing in apartments and what makes apartments a little different than some of the other asset classes. I'm going to share with you my proven recipe for earning double-digit average annualized returns. So I've been doing apartments since 2002. Now I know Tim said apartments is a hot sector right now, and it is. But I wouldn't just do apartments because it's hot, okay? I would do it because it works. And it worked back in 2002. It worked in 2005 when I sold my first 2 properties for over $1 million. It worked in 2008. It worked in 2010, even though lenders weren't loaning on apartments. We were buying apartments, and it still works today. And it still works in DFW. And I also know some people that have this belief that they shouldn't invest now, and they're waiting for the next downturn. Have you heard that from anybody? Well, I'm here to tell you that if you wait, millions of dollars will be made by some people right here in this room. Okay? And you're looking at one of them, but I'm not the only one that's going to make millions of dollars while you're waiting for the next downturn. So people always ask me, well, Brad, what's the secret to mastery? What's the secret to success? There really isn't a secret. The secret is just getting good at something. I don't care if it's single family, mobile homes, foreclosures, but get good at something. And I just happened to make a decision 14 years ago to become a multifamily investor, and I got good at it. So that's the secret, if there is such a thing. But I'm going to share with you the types of properties that I buy that consistently, whether it's an up market or a down market or a flat market, consistently earn average double-digit average annualized returns. I'm going to share with you a couple success stories Actually, I have some here in the room, and I may just call on some people that I know. And then I'm going to talk about some lessons learned, okay? I've learned a few things over 14 years that I'll share with you so that hopefully you could leverage those 14 years of experience and not make those same mistakes that maybe I've made or some of the people that I've trained have made. So, a little bit about me. Are there any engineers in the room? Let me see a show of hands. So I studied chemical engineering. My dad finished 3 years of engineering school. And it was like predetermined from my parents that I was going to study hard, get good grades, and become an engineer. Because my dad maxed out at $42,000 a year. And when I was growing up in Pittsburgh, we used to go on vacations to Lake Erie. Does anyone know where Lake Erie is? This is true. We used to drive, we called it Dreary Erie. Okay, anyone that's from up there? I heard someone say, yeah. So as we were driving every summer from Pittsburgh to Lake Erie, my mom would be sharing how my dad's boss was an engineer, finished his degree, made $80,000 a year, and their family was going to Hawaii. And I knew that my dad made $42,000 a year because my mom would say it. Your father only makes $42,000 a year, and that's why we're going to Dreary Erie again. So I had this mindset that, man, if I just become an engineer, I will have a fantastic life. And then I had this mindset that if I could just make 6 figures, don't you just have this number in your head, or maybe you did in the past, that if you could just hit that dollar amount, that your life would be gravy? Does anyone relate to what I'm saying? Yeah, so that's why I went to become an engineer, but this was me in engineering school. I'm getting all C's in engineering classes. I wanted to change my major because I got all A's in my non-engineering classes. And I'm thinking, God, this is like, square peg, round hole type of thing. But I finished my degree. I worked as an engineer for 4 years. I never really liked it. I changed companies, and I got a job as a technical salesperson, and I was selling to engineers. Because the only person that could talk to an engineer is an engineer. So you've heard of technical sales, right? Well, that's what technical salespeople do, is they could sell to engineers because you could talk the talk. So I worked as a technical salesperson. I did that for a while. And then I wanted to advance in my career. So what do most people do that want to advance in their career? What? Yeah, you go back to school, and that's what I did. So I was living in Houston, Texas, because I got hired by an engineering company in Houston from Pittsburgh. And I went back to school, and they actually paid for me. I went to the University of Houston Executive MBA program. I don't know if there's any fellow EMBA grads in here. Anybody? I was going to say, good, you saved your money, but we got one that, just like me, that wasted $56,000. It wasn't a waste. It actually enabled me to get a 6-figure income. Okay? So I went from making 65 to 70 as an engineer to about 110 after my MBA. But after 7 years of MBA school, I was chasing money. I had a quota. I was in account management, which is a fancy word for sales. If I didn't make my quota, my job was at risk. I was fired once. I was laid off once. And at the age of 35, I was in what they call the corporate rat race. Is there anybody in here that could relate to some of this story? Let me see a show of hands. So that was me. I didn't live under a bridge. I'm not one of these rags to riches people. I'm not a guy that used to cut grass at apartment complexes and now I own them. Okay? Is that funny? There's really somebody like that? Oh, I didn't know. I had no idea. So that was my background. And the big thing that happened for me is the first shift that happened. Okay, so my suggestion for you, and you're all here because you're interested in real estate. This is a real estate club. So this isn't like hanging out at Starbucks and talking to strangers. And so it's a real estate club. So you don't have to be convinced that real estate is good because you're already here, right? But the mindset shift was really important for me. And because I would see, I knew about real estate investing, but truthfully, I just didn't think that I can do it, or I would hear about all these real estate investors, and I thought, oh, they're just, it's a bunch of scam stuff. I'm too educated for this. I have 2 degrees. I read a book called Rich Dad, Poor Dad. Has anyone ever read that book? Yes. And the second book that Kiyosaki wrote, called The Cash Flow Quadrant, and he talks about ESBI. Does anyone know what ESBI stands for? It's employee, self-employed, business owner, investor. Well, I was always on the left side, which is employee, and I had a goal to be self-employed. And then after reading that book, I thought, oh my goodness, I need to be an E and an I. And I felt a little bit of anger at my parents because they never taught me that. But one of the things I learned is you can't learn something from someone that hasn't done it. You just can't. Even if they love you, they can't teach you something they've never done. Isn't that true? So I had to find other mentors, whether it was books or clubs or whatever. And so I learned how to buy apartments. My first investment property ever was a 32-unit apartment building. I never did a fix and flip. I never did a foreclosure. I never did a wholesale. Never. I just bought a 32-unit building. And so you don't have to graduate from single-family rentals. Okay, so if you want to start in apartments, you can. Many of you can. Okay. So since then, I've owned close to 3,000 doors. I own in 5 different states, 6 different markets, and these are just some pictures of properties that I own. I still have properties in DFW. In fact, in January, I bought the biggest property that I ever bought in my life. I bought a $28 million building, and I raised $6.3 million from investors. And where did I meet those types of investors? At real estate clubs. That's the truth. So raising the money is not the hard part for me, and it's not the hard part for you if you know how to network and you know how to communicate clearly what your plan is, okay? I have properties in Florida, Oklahoma, Ohio, Colorado, everywhere I want a vacation. Well, I was going to say everywhere I want a vacation, but I don't want a vacation in Ohio, but it's just a good market there in Columbus, Ohio, so I bought there, okay? So the point is apartment investing works in a lot of different markets, and I'm going to talk today, one of the things I'm going to talk about is what makes a good market, okay? So that's what I've done, and I've won national awards. Tim talked about my trophy. I didn't bring it, Tim.
I love your trophy.
Yeah, I don't know why I didn't bring it. I just figured you've already seen it. So, I won this National Apartment Investor of the Year award. I've been in some of these magazines and stuff like that. Been on TV, Good Morning Texas. But what really excites me isn't winning all those awards. I love speaking and sharing my experience with other people that are interested in real estate. Like, this is my passion. I'm not getting paid to be here. I asked him, he wouldn't pay me. That's supposed to be a joke. But I would do it for free every night of the week. I mean, I really would. If there were events like this Tuesday, Wednesday, Thursday, Friday, next week, next month. I was just in Austin this weekend speaking at a Quest IRA event. So I love sharing my experiences with people that are interested in listening. So that's what I love to do. And now I'm going to talk about why I love apartments and how you might love apartments as well, okay? And some of this stuff is on your sheet. But one of the things I love about apartments is the way they're valued. Now, how many people have heard that apartments are valued by income and not by the market? Has anyone heard that? Well, let me see a show of hands. Okay. So what that means is net income is all the rent you collect minus all your expenses related to running the property. And if you could increase the net income, you increase the value. And so if you know how to increase the net income, which is essentially raising rents and raising occupancy and managing the property better, then you could drive up the income. So have you ever heard of forced appreciation? Forced appreciation is when the skill of the owner and manager could increase income, so you increase the value. So you're not at the whim of the market. You know, if you want a single family rental, if the market goes up, the value of your investment goes up. If the market goes down, the value of that investment goes down. So that's one of the things I love about apartments. Okay? I also love this power of syndication. Syndication is a really fancy term for buying something with a group of people and not just using your own money, but using other people's money. So I shared with you a story about how in January I bought a $28 million building, and I used $6.3 million of other people's money. Okay? And you might look at me and say, well, yeah, Brad, you've been doing that for 14 years, but I've trained people that start in apartments just like you that do it too. Okay? And they might start with a $1 million property and they raise $300,000 or $400,000. You know, and if you're still looking at me like I have 3 eyes, like, oh my God, Brad, that sounds so hard, this isn't for me. Okay? I have a huge database of investors, but if you're willing to share with people, just to prove my point, how many people have $50,000 either in a self-directed IRA or in cash? Look at how many other people have 50 grand. Just take a look in the room. Raise your hand if you got it. Take a look. There's a lot of people in here that's got 50 grand, so you meet each other. Okay, you meet each other, and then you can pool your money together. That's a syndication. Economies of scale is the concept that when you have all your doors under one roof, it's easier, not harder, to manage it. I have some friends that had 20 or 30 single-family rentals, and then they started doing multifamily, and they had all their, now imagine, they got, you know, 50, 30, 20, 30, 40, 50, 100 units all under one roof. And now you can have a property manager, a maintenance person. You don't have to go visit all your properties when you visit. You can visit one property. And actually, the more doors you have, the easier it becomes, not harder. It's counterintuitive to some people. Okay? But could you see how that is possible? Yes or yes? Okay. Financing for apartments is awesome. Okay, and what I mean by that is you can get conventional financing for up to 80% of the purchase price and up to 80% of the rehab. Now, where do you get the 20%? Well, that's where you either have your own money or you raise money from a group of other people. Okay? The other thing I love about apartment financing is non-recourse is available. Does anyone know what non-recourse is? It means you have no personal liability. Imagine getting $1 million loan, a $2 million loan, a $5 million loan that puts, you know, 10, 15% return in your pocket, and you have no personal liability. Now, when I say it's available, it doesn't mean that you're going to get it on every single deal. You need to be able to structure a buyer group that meets those lender requirements and buy a property that meets the lender requirements. Okay? Leverage. Okay, if you're doing real estate investing on your own, you're going to be, I can tell you whether you're doing single family or any type of real estate, if you're a lone ranger, you're limited by your own resources. In order to scale and be a true business owner, just remember ESBI. If you want to be a B, which is a business owner, you have to have a team. You just have to have a team. So you want to leverage other people's time, other people's experience, and other people's money. And apartment investing allows you to do that. Well, let's talk about the money. The combination of cash flow and capital gains on a deal, to me, if I could double my money, which means if I put $50,000 into a deal, over 5 years, that $50,000 should be worth at least $100,000. So that's doubling your money in 5 years, and you should be able to get that through a combination of your cash-on-cash return and your sales proceeds. So that's what I look for when I buy a deal. I have a spreadsheet analyzer. I could do a 5-year projection. I could look at the cash flow, the capital gain, and if I can hit 100% return, I'm going to buy it. And if I can't, I'm not going to buy it. Okay? And then finally, it's a feel-good business. It is a feel-good business because, you know, I've had jobs where it was a feel-bad business. Okay, I had a quota. I actually had a job where I had a quota and I couldn't take vacation over Christmas because my boss said, you're behind on your quota and don't you dare take a vacation because you're behind. So on December 26th, 27th, 28th, I was out making sales calls. And I had a client that was supposed to buy something the second week of February, and my boss called me and said, Brad, you got to pull that sale in on December 31st, so make a sales call on this customer. And I tried calling him, and he was on vacation. And I called him. And let me tell you why I hated it. This was just my experience. I'm not saying you should hate it. I'm just saying I hated it because I already had 1,500 units with professional management. So now when there was a maintenance call, guess who they're calling? My management company of my one rental house. If you have one rental house, do you typically have a management company? No, so who are they calling? I tried to give them my wife's phone number. And she said, you're teaching that seminar. You put your phone number. So the tenants are calling me. When we wanted to put an ad in the green sheet, whose phone number did we put in there? I tried to use my wife's phone number. She said no. So my phone number is ringing. Vacancy. Now we're hiring handymen to come in and fix the place. And they ain't showing up. And we got to do the turnover. And then I got to go with the key and let them in the house. Turnover, I talked about that. Leasing, I got to meet the tenant and sign the lease. And they're asking me about paragraph 9 and these terms and conditions. I'm like, I don't know. Have your attorney look at it. I'm thinking in apartments, my leasing agent does all the leasing. I don't sit there and sign leases with my tenants. What do you think I am, a landlord? Do you think I'm an S, which is self-employed? No, I'm a business owner. What am I doing with a single-family house? Property management and apartments. I got management companies doing this stuff. So all that stuff costs me time and money. So if you compare that with even, say, a 20-unit apartment complex or a 10-unit apartment complex or 100 units, the maintenance is included. You got a handyman or a maintenance person. If you have a 60-unit apartment, you're going to have a full-time maintenance person, a full-time leasing agent. Advertising, it's included in your operating budget. My management company runs the ads. Okay? Vacancy, it's included in your financial model. You include vacancy in your model. You include turnover expenses in your model. You have a staff or contractors that come and do that stuff. And it's included in your net income minus your net expenses when you do your financial analysis. The leasing is included. You have people doing your leasing for you and property management. So, you know, I got like, I don't know, I lose track. People ask me, well, Brad, how many doors do you own? I don't know. Well, I bought over 500 so far this year, 352 in DFW, 216 in San Antonio. I sold 900 last year and made $2.3 million in capital gains just from my percentage of ownership in those deals. But it's a part-time job. I mean, it's less than part-time. My management companies run everything, and I run the management company. Does that make sense? I run the management company, they run the property. Okay, so that's to me a business owner. So all that stuff to me saves me time, saves me money. So my recipe to get the double-digit returns, and by the way, why are double-digit returns important? Because you can't retire and get rich fast if you make single-digit returns. Does everyone know the rule of 72? You take 72 and divide by the rate of return, your annual rate of return. So if you have your money in a money market and you're making 0.25%, your money doubles in 288 years. 72 divided by 0.25. And so even if you're a baby, you can't get rich. Your money won't double fast enough. Okay, so if you make 3%, your money doubles in 24 years. If you make 6%, you do the math. So to get rich fast, and not get rich quick like some scheme or some scam, but to get rich fast, you got to make double-digit returns so your money is doubling every 2 to 3 or 4 years. That's why double-digit returns are important. Okay, so you got to put together your financial statement, see how much liquidity you have, and you should be making double digits on your money. And if you're not, then you're not going fast enough. And that's my opinion. Okay. Now, who's to say you're not going fast enough? But if you want to get out of the rat race or have more money or expand your lifestyle, those are the type of returns you need to make. So to do that in apartments, I suggest you buy B-class and C-class properties. These are the properties that are generally built in the 60s, 70s, and 80s. They're generally properties that are inhabited by the working class of America, the people that make $30,000 to $50,000 a year. Okay? We're not buying the lowest end properties with government housing. We're not buying the high end with the professional class, the yuppie class. Okay? We're not buying those buildings in Uptown. We live in them, but we don't buy them. Okay? That's where the sweet spot is. You want to select the right market. And on the next slide or two, I'm going to talk about what's the right market. Okay? You don't need to have 60 units or more, but if you want to have professional management, which makes it easier for you, you buy a 60-unit property. Now, I know what some of you are thinking. You're thinking, well, I don't have the money to buy 60 units. Be honest, is anyone there thinking that? You don't need to have all the money. It helps if you have some money, but you don't need to have all the money or all the credit or all the liquidity or all the net worth. You need to bring something to the table. But you could assemble a purchasing group because the lender is going to look at the group. They're going to look at your money plus his money plus his money plus her money. And they're going to look at you together and say, hey, do these 5, 6, 10 people have enough net worth, liquidity, credit, income to get this loan? And do they have enough for the down payment? Okay? So that's what you want to be looking for if you want to do a syndication and buy a deal bigger than you could afford with your own money. Now, I know for some of you, again, it's a huge mindset issue because, you've been taught, I was taught my whole life that, if you don't have the money, you can't do it. But that's why my dad is still alive and he pinches every single penny. He's afraid he's going to run out of money. He had 320,000 miles on his Mercedes, But that's not how most of us want to live our lives. Okay? I look for stabilized properties with some upside. And in the language that makes you look sophisticated, you tell brokers and you say, hey man, I'm looking for a stabilized property with value-added opportunity. Now I'm just going to do this as a plug, and he may hate that I'm going to do it or he may like it. But I know a guy, Doug Banerjee, right here. Doug, you want to say hi to everybody? Sure. Doug's an apartment broker, and he specializes in apartments, and I'm friends with him. I've bought a lot of deals from him. He sold some of my deals. And I would just say, if you're looking for deals, you need to know people like Doug. Now, Doug, if all these people come up to you, you're going to hate me. But the truth is, don't come up to him unless you're serious, okay? But he's got it's a good old boy network. There's 10% of the people that control 90% of the deals. And so you want to know people like him, and other people in the business. So that's also how beginners get started, is by leveraging experienced people in the business, okay? So a stabilized property simply means the property is already performing well economically, but it could perform better. That's what the value add basically means. I'm going to buy something that's already doing okay and it could perform better. And that's what the banks like, that's what you like, that's what your investors like, okay? And I like to hold these properties for 3 to 5 years and then exit, because once we can go in and drive up the value through forced appreciation by increasing income, by increasing occupancy, then we build up equity in the deal. And what good is the equity in the deal if it's in the deal? Especially, what's your name here? Tim, if you gave me $50,000 as an investor in a deal, and we held that deal for 30 years and that equity was tied up in the deal, and you're getting 10% a year in cash flow, that's okay. But what if, you put 50 into a deal and within 3 years you get 125 back.
Needs to be working somewhere else.
Yeah, well then, yeah, some people complain, well now what am I going to do with the money, Brad? Well, take a little bit for yourself, because anytime you make some money, you should take a little bit for yourself and your family, go on a vacation or expand your means, but take the rest of it and reinvest it. And that's how you enjoy your life and get richer. If you just take all your profit and spend it all on a fancy car, you're not doing yourself any good. But if you take a little bit for yourself, I usually take 10 to 20% of every profit I do, and I buy something for myself or my wife. We buy a car, we buy nicer clothes, we bought my wife's mom a car for cash because we could afford it, but most of the money we reinvest, okay? And that's why the rich get richer. You know, and politicians are out there to stop us, but 99% of the people are not in the 1%. That's supposed to be funny. But it's just, you know, but the point is, if you understand the cycle of buy, hold, sell, and repeat, and you do that the rest of your life, you'll be, and that sounds cheesy, but you'd be the envy of your friends and family. I mean, all my friends that I went to college with are still in their jobs, making, you know, 110, 120 a year. They all think, what the hell are you doing, Brad? How do you have a beach house in Florida, and how do you have such a great life? And I'm like, well, 14 years ago, I made a decision to get into apartments. And my life didn't change overnight, but it changed little by little every single day. And over a longer period of time, the gap just gets bigger and bigger and bigger. Does that make sense? So it's the decisions you make today that are going to impact you, not necessarily tomorrow, but like 3, 5 years from now. There'll be huge differences. So where do you want to invest? Well, number one, you want to invest in a place that's landlord and business friendly. That's very important. Number two, I suggest you invest in a place that has a cost of housing that's at or below the median, the U.S. median. So like if a 322 costs, the median 322 is about $250. In DFW, it's about $250, $260. So we're kind of in that median range. But if you're in San Jose, California, where the same 322 is $925,000, that's a pretty good indication that the prices of real estate are inflated and you're not going to get a double-digit return there, okay? You want to look for places that have high job growth and high population growth. That is my four-pronged holy grail of the recipe. Now the fifth one is familiarity, and that's just the bonus. I have a lot of students that invest where they don't live because they live in expensive places like DC or Seattle or California. But because we're here in Texas, you can invest in your backyard because Texas and DFW specifically meets all these criteria. Texas is the #1 landlord and business-friendly state in the country. We lead the nation in population growth, job growth. Okay, so it's a great environment to invest. And so if you follow this recipe, you should have higher returns and lower risk. And I believe that's what everybody, how many people want higher returns and lower risk? Say aye. So that's the recipe, okay? So Texas is still a great market. Now I hear some of these gurus speak, and they come to Dallas, and then they go to Tampa, and then they go to Boston, and then they go to LA, and then they go to Nebraska, and every city they go, they say, you're an emerging market. I heard one of the guys, you probably know who he is, the landscaper, and he said, Dallas is an emerging market. And I'm sitting there going, no, it's not. It was in 2009. So here's the little secret. Dallas has emerged. But it's still a good place to invest because we have population growth, job growth, continued, robustness in our economy, continued rents growth, continued jobs are companies are moving here, people are moving here. Okay? So within Texas, I like the Texas Triangle, which is Dallas, Fort Worth, Austin, San Antonio, Houston, and everything in between. Okay? That's the sweetest spot in Texas. Now, other markets in Texas are still good, but my experience is telling me that DFW, Fort Worth, Central Texas, down to Houston, and everything in between is the sweet spot. Okay? So what does Marcus and Millichap say about the buying environment? All these slides are mine except this content on this slide I copied from Marcus and Millichap, and Marcus and Millichap is a national commercial brokerage firm. So this is what they have to say about 2016. Well, first of all, they said most of the deals that happened in 2015 were in primary markets, so that's big cities. And they said that people seeking higher rates of return are looking in the secondary and even the tertiary, which are the smaller and smaller markets. And that's what I see too, okay? We're seeing that a lot. And so I'm helping a guy right now look at a deal in Ennis. Does anyone know where Ennis is? So that's what you would call a tertiary market. So if we still, sometimes you got to look a little bit outside of the major, because DFW is hot, so you can look in some of the smaller areas. We still look in DFW too, by the way. Okay, if anyone's waiting for the market to turn this year, it ain't going to happen. Why? It's simple math. Okay, if rents keep going up and occupancies stay strong, remember I said NOI? If you raise the NOI, you raise the value. Well, if you own the property and your rents go up 5% this year and your occupancy stays the same, your value just went up. So the values of the properties are still going up. And some people were like, well, Brad, should I pay this much for the property? And I'm like, well, if the returns are there, then you should. Okay? So the values are still going up. So we're going to see continued pricing increases in 2016. This is Marcus and Millichap. They have finally came to the same conclusion that I've had for 14 years. They said the best acquisition opportunities are in Class B and C properties. I'm like, duh. Okay, but that's what they say. Okay. They expect interest rates to remain low. I remember last year everybody was all afraid about interest rates. Well, interest rates are still lower. They're still really low, near historical lows. And we will see some foreign buyer activity increase. So that's what we expect in 2016. Now, my lessons learned, I'm just going to put a whole bunch up here because I only got a few minutes left. So I'll just put these up here and say, I think it's okay if I go 5 minutes over. Is it okay with you if I go 5 minutes over? All right, so if they come kick me out, say, no, we love Brad. Let him have another 5. Tim, can I have 5 more minutes? 3? They want more. You see? See that?
It's like my 6-year-old. Keep talking, I'll keep going down.
5 minutes.
I told you 40. You got 3 minutes left.
Okay. So these are my lessons learned. If you just want to take a picture of that. Okay, let me just hit on a few of them. Focus on how versus why. That's a mistake. So many people say, well, how am I going to do it? I never thought about how I was going to do it. I thought about why I wanted to do it. I wanted to make $10,000 a month so I can get out of the rat race. That's what drove me. I didn't sit there and say, well, how am I going to learn to analyze deals? How am I going to raise the money? How am I going to get a loan? How am I going to manage the property? If you ask yourself those questions, you will never give yourself permission to move forward. Does that make sense? Allow yourself to move forward. You set your target and you move toward it. Okay? And I also just want to talk about effective networking. So many people go to networking events and they're just wasting their time. You should go with a goal. If you're at this event, you should have a target. You should say, hey, I have a deal, I want to wholesale, and I want to find a qualified buyer. Or if you're a multifamily syndicator, you might say, I'm looking for people that have $50,000 so they can invest with me. But don't just go there and talk about sports and the weather and the Rangers home opening day. Who cares? I mean, I care, but not that much, okay? So those are some things I wanted to hit on. A lot of these are, specific to apartment investing. And actually getting bad advice or getting no advice is a big mistake. One of my favorite singers, Pitbull. Anyone know Pitbull? Yeah. Pitbull says, ask for money, get advice. Ask for advice, get money twice. And he sings it pretty cool, like in a rap song. And then finally, Tim, I'm done. These are all the deals that I've helped people buy. Over 2,600 units just last year, all over the country. And anyone that wants more information, this is how you reach me. All right?
So I'm going to interrupt and go back 2 slides.
Oh, I thought I had to go. Now he wants me to go back. Thank you.
I'm helping you.
Yeah.
One more. So, I love this, right? Because especially the how versus why. I was talking to this investor about 20 minutes ago, and he said, yeah, I'm going to form 2 LLCs this month. I said, cool. How many houses you bought? None. I was like, whoa. Why are we forming 2 LLCs? He's like, well, I was just told that you needed one for fix and flip and one for buy and hold. I said, okay, cool. So let's start with one. And if your first house is a fix and flip, you don't need another till you find a buy and hold. He goes, well, but the first one may be buy and hold. I said, okay, cool. So let's do the first one as a buy and hold. And then if the next one's a fix and flip, we'll start another one. He goes, well, no, the second one will probably be buy and hold too. I said, okay. So I still don't see why we need 2 LLCs, right? So it's like so much of what Brad's, like, I love this slide. I mean, this is like you could have an hour-long talk on this.
This
right?
is an hour talk.
I mean, it's haste versus optimism. I mean, it's raise enough capital. It's important because everything I see up here, and Brad, I've never seen this slide before, so I'm not like the guy out of the audience that got up and got a microphone. I mean, it's everything I see up here is very, very important to success. And so if you didn't, are you offering out like to email these out, or they got to take a picture?
I could do that. Yeah, I mean, if they send me an email.
And your email's on the last slide?
It will be in a minute here. I'll put it up there.
Yeah, I mean, if you do anything tonight, guys, take a picture, ask for this slide, get this information, because if you're not going into multifamily, if you're going into single family rental, or if you're going into fix and flip, I can tell you, like, literally, starting too small, very important on fix and flip. I'll get you 1 second, bud. You can put your arm down. Focusing on how versus why, right? Very, very big. Those that focus on the how always work for those that focus on the why. My buddy Brian Dodge used to say that. Goals, it's just networking, right? I mean, anybody know why we started DFW Investors? I get a big list. Ha-ha, trick. Right? You thought you were here to grow your business and everything, but you're actually growing ours. That's the whole thing. And then it's how we talk to you and how we tell you what we want that drives our business success. And then, the rest I won't go on. So,
well, let me add something. Yeah. I've heard this thing. Your net worth is equal to your net worth or something. Has anyone heard that? I think that is the most crazy thing I ever heard. It's true, but only if you know how to make that happen. I've met people that have huge networks and they're broke. You got to know what you want out of that network. Are you looking for investors? Are you looking for buyers? Who are you looking for? So you got to know how to optimize your network. It's just like people that say knowledge is power. No, implementation of knowledge is power.
Power is power. Knowledge is knowledge.
It's
how you use the knowledge.
It's how you use it. It's how you use your network. Okay. Goals. The thing you should work on the most before you find a deal is yourself. Figure out what you want out of life and why you want it. Then go and invest. Okay. People were like, "Oh, I'm looking for a good deal." Well, what's a good deal to you?
Is my buddy Mac on this slide? I changed
Mac
the slide.
Lawson. No, these are just the 2000 pictures of 2015. So Mac,
So one of my buddies in the business that is probably, I don't know, a list of your clients, but one of your more successful students or clients or friends or whatever you call him is Mac Lawson. And it's been neat to watch Mac, and Mac is still a great friend of mine, and he told me we were at the Ranger game together today, and he said to highly recommend Brad. So Brad.
That's the automatic thing. I'm not even touching that now.
No, I'm clicking it.
Oh, that's you?
I've got like a backup in case you kept talking.
I'm like, what's going on?
So how do they email you? Brad at Brad Sumrock, Brad at me, what is it?
Well, if you want to take a picture of this, I run a meetup group, local here. I'm a big Facebook junkie. I spend way too much time on Facebook, but I got a personal page and a business page, and it's full of content. Okay, you're not going to see when I'm eating pizza. Okay, you're going to see deals that we're doing. Okay.
You do post where you eat pizza.
I don't eat pizza, Tim.
Oh. Well.
At least not publicly.
Greek food.
And let me just put my email address up here.
So while Brad's doing that, just so everybody knows, we're about to take a 10-minute break. And then Scott Belzy's going to speak. I heard he's here. I haven't seen him yet personally. So just 1 second while Brad puts his email up there, and then we're going to give everybody a round of applause. And actually what we're going to do is we're going to take a break from 8:15 to 8:30. So we're going to take a 15-minute break. And then the next round of class will go from 8:30 to 9:10. So there's no Shark Tank tonight. I know the website said that originally. And then the bar will be open till 9:30. So
There's
support
my
at retiremebrad.com.
That actually goes to me. You're looking at my support staff. Actually, I do have an assistant that's at my booth, and we are available at our booth.
Yeah, so like right behind that wall by the popcorn is Brad's booth. Please be back in here at 8:30 for my good friend Scott. Everybody give Brad a round of applause, please.
Yeah.